Welcome back to another Market Insight Call, joined as always by Aaron Tuttle. It's our first show back since the election, so we'll get into today's topics. We're going to go through Trump's tariff policy. We could spend a bunch of time on it, but we actually in June had a call summarized pretty well by Steve Chiavarone. Gives a really bullish take on what could happen with tariffs domestically. Look at asset classes, how they're responding now versus Trump's first term. We had a strong rally of NVIDIA heading up into its quarter and then kind of fizzled out a little bit. Does the market need NVIDIA to keep the rally going? Then we'll look at the end of year seasonal patterns. We'll take a look at Steve's video from June.
On the tariff side, which is the second kind of key element of policy, you're probably looking at relatively status quo trade policies if it's Harris or some other Democratic nominee that wins the presidency. Maybe a little bit more on Chinese steel, but generally the kind of similar trade policies. Trump's talking about, and I think while the best thing I've ever heard about thinking about Trump's policy proposals is you should take them seriously, even if you don't take them literally. So he may not go all the way on these policies, but to brush them aside and say he's not going to move in this direction would be a mistake, I think. So he's talked about a 10% across the board tariff on imports. It's unclear as to whether or not that includes or excludes countries where we currently have free trade agreements. He's talked about 60% on Chinese imports and 100% on the importation of foreign cars. So a significant kind of change in tariff policy. And that carries with it some negatives and some positives. So the negatives are, clearly that would lead to an increase in prices, right? You're going to have goods being more expensive to be imported. However, I think about a foreign car maker, a Japanese car maker that is using Chinese components and assembling a car in Mexico, right? They assemble the car in Mexico because then it gets shipped in as a Mexican import, which is not tariffed under the USMCA. Under this tariff regime, that would no longer be possible. That car would be hit with as much as 100% tariff. I'm fairly certain that Japanese automakers aren't just going to say, well, we don't need to sell cars in the United States anymore, right? Instead, that factory now has to be in Alabama. And I love Alabama. It's a wonderful place. But you know what we don't have enough of in Alabama? Everything. We don't have enough natural gas pipelines and utilities and factories and restaurants around the factories and multifamily homes around those factories. And so if all of a sudden that Japanese car maker needs to go to Alabama, that needs to be built. And that's going to be financed by smaller local banks. You're going to use local construction companies. My dog didn't like that idea. Local construction companies. There is a benefit to that on the other side. Whereas on the Biden policy or the Harris policy, you're going to have cheaper goods, you're going to have better trade relations, and multinationals are going to be favored in that scenario. So large caps better in one, small caps better in the other.
What Steve closed with was, of course, small caps being favored under this change in administration. And that's exactly what we see here with this chart. The S&P 500 is large cap. That's the lower line, up about 4%. Small cap S&P 600 up over 9%. A lot of what he talked about, deregulation. Brian Westbury from First Trust covers that a lot. He estimates regulation costs of compliance is over $2 trillion a year. So if there's the hope and maybe that some of those regulations can come off, small caps benefit since they have a higher compliance cost relative to large caps. Financials have outperformed technology against small, and then US companies have outperformed international. A lot of what he described, right? There could be a higher demand on the financials over technology. We'll talk about that later, which is that held for a little while, and then it started to fizzle out into Trump's first term.
So instead of replaying all the great clips that we have in our library, you could just hit subscribe so that you're always on our feed so you get that indication as we're going live. So if you haven't done so already, hit that subscribe button down there and make sure you like it and share it with your friends.
One thing that hasn't changed was in the middle of this rally, we had an inflation report on the 13th of November, brought the market down a couple percent from its rally, pulled off about half of that initial reaction from large caps, showing that inflation reports still matter to the market. We did get past it. There's a couple reasons of why I think that could be, but I think it's still the same theme that's going to matter. And we can look at this, when we look at what happened, well, CPI ticked up, the 12-month measure went up to 2.6. It's elevated. some base effects from last year that were moved out. If that happens to PCE this week on Wednesday, by the time this comes out, PCE's probably already been released. That's the one the Fed watches. If PCE is elevated that high, market's going to have a problem with it. Right? We'll show what Fed rate cuts look like. But as long as PCE is well behaved in the low twos, I think the market's going to be fine with inflation.
This is one of the things that I think the market, at least whenever I see it, I'm always confused by their statements because sure, Trump tariffs would be inflationary, but at the end of the day, inflation is always and everywhere a monetary phenomenon, right? It matters what the Fed is doing. But of course, the indexes and the price can move. And certainly if you increase the tariff costs, it's going to increase the cost of goods that are brought in. But then, as Westbury was talking about, the deregulation and reduce of cost and burden of government can also bring those prices down. But we've consistently increased the money supply for decades now, and inflation's been low. But we've talked about that several times here, where there's a lot of factors that were the amount of the global workforce at that time. We had fracking. We had a lot of things that were playing into the index price coming down. I don't think those trends are really going to change, but I do think the deregulation component is going to help offset some of that inflationary component. And then once again, the Fed, depending on how they see monetary policy, is ultimately what's going to dictate whether prices can continue to go up.
And one thing they seem to agree on, and since they've been coming out talking since the election, is that this doesn't happen right away. It takes a long time for some of these effects to hit the market. And so when they're trying to coordinate policy right now, and they're thinking, well, if tariffs increase prices one time in the future, is that truly inflation for the way they measure it, which would be a sustained increase in prices? So they don't seem to be as worried about it. I think that's one of the reasons the market moved past the little bit hotter CPI. It was the expected number. It wasn't. It did tick higher. It was exactly what the market was expecting, but it wasn't the continued downtrend that would have been great for the market to see, down towards 2%. Another alternative measure, Jeremy Schwartz tweeted this out, who hopefully we can get him on again in January. I know he's been on the last 2 years to kick off our.
Well, we got to see if his calls were right.
Yeah. He shows that using a real-time rent measure from apartment lists, that inflation numbers are a lot lower than seen. And so that's one narrative that could be out there in the market. Another positive thing we've seen, all of what you just described, which is if inflation's higher and growth is higher, well, the market's going to be okay. Market's near all-time highs. And here's the forecast for what the Fed's going to do next year with cutting rates. We're only expecting 2 to 4 cuts. Previously, it was 4 to 6. That's pretty pessimistic for rate cuts next year if that inflation's sticky, and markets are pretty elevated still. So there's not a big effect from what we would have expected. If you said these cuts were pulled out of the market, a couple quarters ago, you'd expect the market to react and be
Absolutely.
down. You talked about what the Fed was projecting going forward. We can also take a look at Commerce Secretary nominee and Treasury with Howard Lutnick and Scott Bessent. And of course, we talk about Trump is not good at talking about policy or having plans, maybe as a concept of a plan. These guys are a little bit better at that, and Wall Street and the market certainly like them talking about policy a lot more than they do when Trump talks about policy. And they said a lot of what you just talked about. Tariffs, they see it as a bargaining chip. And I don't know if you've ever heard Trump say it. I don't think I have, but these guys, Lutnick has said, we only want to tariff goods that we make. We would be silly to tariff goods that we don't make.
Yeah,
right?
absolutely.
That would lead to some of those price increases, significant price increases. And that's the scary one, because Trump usually doesn't distinguish between the two. And then you get the headlines of, if he does this, there's going to be recession.
Right. I think Ricardo's comparative advantage is how we understand tariffs, and tariffs are going to increase costs as net. But that's not what we're talking about as standalone. One thing you don't want to do is you don't want to try to grow bananas in Maine, right? You want to export your maple syrup in exchange for bananas. Another thing we don't want to do here in the U.S. is make snow globes. There are things that we just don't want to do in the U.S., but there are things that we do want to bring more of. I think semiconductors is obviously an area that we want to do more of that here in the U.S. And if you're using tariffs as a bargaining chip and creating incentives for companies to invest here, not only is that probably good for the human capital here and favoring a lot of the higher tech jobs, but there's a lot of reciprocal things that happen, which was mentioned in the video. In the video that we posted, is that you actually have a lot of secondary and tertiary effects that would probably be a benefit to many people in the U.S. Will prices go up? Yes, but with the amount of AI and productivity gains that we're having, it probably isn't a one-to-one ratio type of component that you think and see in financial models where it's just you just continue to ratchet up. There's a lot of effects that are going to be popping up as deflationary just as much as there are inflationary.
Right. And these guys have both said they don't want to see this happen day one. They want it to phase in with tariffs to help exactly what you just said, no shocks, and really set up policy. And they said the same things you just said, disinflation from deregulation, energy prices down, and then the big one, if it can happen, budget deficit. I think that's probably reducing that. I don't know if that's...
I'd give that the lowest probability.
Yes.
And ultimately, why we're going to continue to be in an inflationary world, despite the indexes of government spending more money than it's collecting, it's got to get it from somewhere, and that's the central bank. So there's the easing, despite where interest rates are. But we'll get too wonky if we get into that.
And then if we look back at a portfolio optimization, not something we do. Return divided by risk is usually a metric of optimization to see what performed well during Trump's first term. It's exactly what we've been talking about today. The Trump trade has followed exactly what happened the first time. Lasted about a year, small caps, financials, and then it shifted. Technology, large caps started outperforming about a year later. I don't think it's as simple as just running the past playbook. We just wanted to look at it just to understand kind of what the market might be thinking. There are two big differences.
Right, you can't just run that playbook, right?
No, you run that playbook, it's filled with a lot of error and forecasting that the future is going to look exactly like the past. And the big difference was in Trump's first term was a tightening cycle. Since he took office, 8 rate increases, while right now we've had 3 cuts. So when you look historically at what performs well during tightening and easing cycles, they're very different. Right? So there's potential that maybe the Trump trade, which is what performs well during rate cutting cycles, could continue longer than maybe it did last time. But at the same time, those big technology companies that are just fantastic businesses continuing to grow assets and grow cash flow may continue to perform as well.
Yeah.
Those large companies are contributing to the headline risks that we keep seeing, which is stocks are expensive. The problem with that is, what do you do with stocks being expensive? Bonds have been selling off, and cash rates are reduced and probably going to continue to be reduced. Whether they're reduced by more than expected or less, they're still down significantly from cash rates. So if you rebalance here, you're selling what's performing really well, buying bonds that are not performing as well, or putting it into cash, which expected returns on cash are coming down significantly. So it is a difficult decision trying to pull together all these factors and determining a rebalance. I think it's going to make sense going forward. Maybe right now isn't the best time, but it's something we're continuing to discuss with all of these factors. We'll take a look at those PE multiples, because that's the main one. That's the headline that we're hearing right now, which is price to earnings multiples, the price divided by the earnings of expected earnings, are elevated, and they are. The PE on the S&P 500 is at over 22 times earnings. Really only seen that a few other times in history, and those weren't great times for the market. The median PE on the S&P 500 is not as elevated. So it gets you to what we were talking about. Those large companies' PEs are pulling up the rest of the index much higher, but the median company is significantly lower than that at only 18 times. That's the red line, elevated, but not extreme as some of the blue line has been there. Another way to look at this, and this is a terrible indicator for timing, it's just to show expected growth, which is the PE divided by the growth rate, the PEG ratio, which is to say, if you do get the growth, is it a reasonable price to earnings? And it is. At 1.25, roughly, is a reasonable multiple if we get the growth. It's conditional on the growth, right? You can look back historically in 2021, you didn't get the growth, and it was not a reasonable PE. And there were other times where in 2012, PEG was low, which is a good thing, and you did get the growth, fantastic returns for the market.
Right, so it's price to earnings certainly matter, and we are paying a premium for earnings. Something's got to happen. Price has got to come down or earnings has to go up. And when we look at that PEG ratio, which is the price to earnings to growth, it's saying that the growth of earnings is what's going to change. So the earnings, the E is, based on this data, is what is expected to change, not the price.
Right. Another alternative way of looking at it is looking at a global index This is the All Country World Index, not nearly as elevated. International stocks are not trading as high multiples, and domestic small and mid cap are also not trading at high multiples.
And I think that's an important case to make, is that PEs across the globe are not elevated. PEs in the U.S. are elevated. So you have the option to go buy lower PEs, but you're not doing it. Why is that? That's because people are seeing that there is a growth potential and a premium to pay for U.S. stocks for a reason. Now, history is going to tell us in the future whether that's a right call or not. But there are just as many bullish cases to make here as there are bearish cases. Once again, you talked about the playbook. Don't just play a playbook because it's shaped out like that before. Understand what's driving that and what may be different in the playbook.
Yeah, absolutely. And one of the strong growth engines, the AI build out, we got NVIDIA results last week, and the numbers were fantastic. Well, the market reaction to it was not. The expectation was really strong for the number, even though they beat revenue, almost 100% growth year over year, and their earnings came in far above consensus expectations. The market expected a little bit more, but it gets back to the question of, did the market need NVIDIA? They didn't need NVIDIA to perform well. We can see here below, NVIDIA was down over 3%. Small cap indexes were up over 1.5%, and large cap indexes, which have a huge chunk of NVIDIA, were still positive. So they didn't need NVIDIA to perform well. They needed the stock. They do still need the theme. Like you've talked a lot about AI. That theme is still in the market, and this was a status quo report that would help that theme of AI build-out continues, which leads to much higher productivity, as you've been discussing. And as long as there's that disinflationary theme, which those go together, lower interest rates, that's what the market needs. And all of that's still in order from this report.
Absolutely.
And then to close out the year, we're looking this is the strongest seasonal period on record. It's not on this chart, but November, December, and January are the strongest 3-month rolling average across all 3 months that you could have from a rolling average perspective. And this is a chart specifically for election years, showing November tends to be a strong month. We saw that, and we're seeing that now. This is actually typically one of the strongest weeks in November, as you can get some optimism around retail and Black Friday. Usually you get some good notes that come out that things are looking good. If that happens, would expect to see a rally that continues into year end. And then December, on record, 83% of the time is higher. So it is actually the highest percentage on any month that shows the probability of the month being higher is the strongest, with a 1.3% average return shown in December.
And all of those statistics wouldn't matter who was coming in on January 20th, right? A lot of these trends were already in place. There are certainly asset classes that have favored from one or the other, but I think we've been in a kind of a stagnant, slow grind market for a while. And a lot of these problems are kind of in the rearview mirror. That's not to say we don't have future problems, but I think a rally here and those PE ratios make a lot of sense, that it's the earnings component that we're probably moving into a cycle that might actually feel a little bit like a boom, which we haven't had in quite some time.
And like you were saying, that Steve was referencing it, if the election had gone another way, would we have just seen small cap sell off and large cap technology rally? But potentially would have seen that.
Probably.
Right?
I think that would have been a likely scenario. So once again, it's who is favored in these situations, but I think the market is setting itself up for, either way, a good scenario.
Yeah, and we didn't mention it. The obvious part, it was not contested. Simple. It was a clean election, and that was a lot of the fear, right? If you're a big allocator trying to put cash to work the week before the election, and you have fears that could happen. Well, it didn't. You were going to put cash to work regardless after the election, and that's the rally you see as well.
That uncertainty is gone now.
Thank you for joining us today. We'll be back next month to close out 2024 and start with our 2025 forecast.